Okay, let's dive right into this explainer. The KOSPI officially closed up 0.97% today, hitting 6,808.21. That's a solid second straight day of gains for us. So what exactly drove it? Well, we've got a really interesting mix today. Breaking geopolitical news, shifting global yields, and some massive rapid-fire sector rotations. We're going to move fast, process the data, and extract the real market principles at play here. Let's get right to the numbers.
To figure out why the Korean market rallied, we first have to zoom out and look at the macro canvas. Focus your attention on oil for a second. Unconfirmed ceasefire rumors between the US and Iran literally just hit the wires, suggesting a potential agreement that actually included free navigation through the Strait of Hormuz. Now, while unconfirmed by major officials, the market reacted instantly. The geopolitical risk premium just evaporated. West Texas Intermediate crude tumbled 2.28%, closing at $80.48 a barrel, and Brent crude also dropped sharply by 3.59%. This is a crucial macro shift because lower oil prices immediately mean lower energy import costs for South Korea.
Now, watch how this data cascades through the whole system. This sudden drop in oil prices instantly erased our immediate energy inflation fears, and a lower inflation outlook feeds right into the policy rate path, right? Combine this with a weaker Conference Board Expectations Index, which lowers the U.S. growth outlook, and bond yields took a total dive. The U.S. 10-year Treasury yield dropped by a sharp 6.7 basis points down to 4.630%. South Korea's 3-year and 10-year government bond yields immediately followed suit, dropping 1.7 and 3.0 basis points respectively. And this brilliantly illustrates our first core principle today, the relationship between yields and equities. Why do falling long-term bond yields matter so much to the stock market? Well, it's all about the discount rate. Falling yields lower the discount rate applied to a company's future cash flows. A lower discount rate automatically raises the present value of stocks. It's like releasing a pressure valve. This dynamic gave the domestic market in Yeouido the exact breathing room it needed to rally, particularly for large-cap growth stocks that carry a higher share of future cash flows. Institutions totally seized on this, buying up a net 760 billion won of KOSPI shares in cash trading today. Section 1. Tangible sector wins, institutional flow. Let's see where that money actually went. A pivotal report surfaced regarding the U.S. and South Korea. The U.S. government has reportedly requested that South Korea acquire a partial stake in Westinghouse. If this stake acquisition goes through, it fundamentally strengthens the business relationship between the two nations. But more importantly, it radically expands opportunities for Korean companies to join U.S. nuclear plant construction projects. The context here is absolutely massive. The U.S. government is officially targeting the start of construction on 10 large nuclear reactors by 2030. The market immediately began pricing in this huge expanded opportunity. So, the crucial takeaway is that this directly benefits domestic manufacturing heavyweights. Just look at Doosan Enerbility's 6.32% surge today, which brings its 2-day gain to roughly 17.5%. Why? Because if nuclear projects increase, the contracts for reactor vessels and steam generators increase, and Doosan manufactures exactly these components for both domestic and overseas plants. Institutions aggressively bought a net 96 billion won of Doosan Enerbility today, making it the second largest institutional purchase among all KOSPI-listed companies.
Now, what's really interesting about this is the spillover effect didn't just stop at parts manufacturers. Domestic construction firms with actual nuclear EPC experience, that's engineering, procurement, and construction, saw massive institutional buying and explosive daily gains. Hyundai Engineering and Construction jumped 7.5%. Daewoo Engineering and Construction rose 8.4%. And KEPCO Engineering and Construction, which actually designs the APR 1400 reactor, skyrocketed 13.63%. The entire construction sector index rose 5.7% as the market eagerly priced in future contract wins.
Section 2. Semiconductor standoff. Tech heavyweights.
Pivoting over to the tech sector, we are seeing a fascinating, high-stakes standoff play out ahead of Nvidia's highly anticipated earnings report. Both Samsung Electronics and SK Hynix are critical suppliers of HBM, high-bandwidth memory. But, you see, their sensitivity to Nvidia's AI chip demand differs drastically. SK Hynix is highly concentrated. HBM makes up a massive share of its core earnings, linking it directly to Nvidia's accelerator demand and HBM4 supply plans. Samsung supplies HBM too, but they're heavily cushioned by commodity DRAM, NAND, foundry, and mobile business operations. This fundamental difference in earnings sensitivity really dictated today's extreme trading flows. This creates a serious tug-of-war on the order books. On one side, you have immense foreign offloading due to uncertainty and risk aversion ahead of Nvidia's report. But on the exact opposite side, you have a massive wall of corporate buybacks actively defending the price. It's a literal standoff between foreign capital seeking to reduce risk and domestic corporate capital establishing a rigid price floor. And to put that into perspective, these are just astronomical buyback figures. Samsung Electronics is executing a 15 trillion won buyback. SK Hynix is executing a massive 40 trillion won buyback. This corporate capital is acting as a powerful physical floor for the market. Over the last several days, hundreds of billions of won have been deployed daily, counted as other corporation transactions, just absorbing the incoming sell orders. However, you've got to look at this sudden divergence today. Foreign investors had been selling both tech giants on Monday and Tuesday. But today, they totally flipped. They shifted to net buying Samsung Electronics as their largest daily purchase, while they continued to heavily sell SK Hynix, which remained their largest net sale. In fact, SK Hynix recorded a 3.46% short-selling turnover today, which is the highest among all KOSPI-listed stocks. So why the sudden preference for Samsung over SK Hynix? Well, it comes down to strict institutional risk management. Samsung's heavily diversified operations offer a much safer harbor. If Nvidia's forward-looking HBM guidance happens to disappoint the market, SK Hynix's earnings estimates will require a much sharper downward adjustment. Foreign capital is seeking the relative safety of Samsung's broader operational base while still maintaining their exposure to the tech sector. Furthermore, Samsung's short-selling turnover fell for a third straight session, dropping all the way to 1.96% today. The pressure there is clearly easing up. Section 3. Hidden Signals. Retail Profit-Taking. Let's see what's happening behind the scenes. We've tracked the macro shifts and the institutional divergence. Now, domestic individual investors unleashed a massive 2.24 trillion won sell-off today, and it was highly concentrated. Over 1.28 trillion won exited Samsung Electronics, and 709 billion won exited SK Hynix. Combined, our two tech giants made up nearly 88.8% of all individual net selling today. On the surface, dumping over 2 trillion won looks like a mass exodus from the market, right? Actually, don't misread this data. Context is absolutely everything here. Retail investors aggressively bought these exact same two stocks during Monday's sharp market dip. So today's aggressive selling point strictly to healthy, strategic profit-taking into the market's recovery. It's not some new bearish panic. They correctly bought the bottom earlier in the week, and today they just locked in their gains as the prices recovered. Smart move. And this brings us to the final reality of the day. Despite the heavy multi-trillion won retail selling in the top two giants, the broader market absorbed the volume perfectly. Out of 944 listed KOSPI stocks, 585 actually advanced today. Large caps rose 0.9%, mid caps rose 1.7%, and small caps rose 0.7%. This rally was incredibly broad, well supported by institutional cash, and deeply resilient across multiple sectors. So today really showed us a market maturing, shaking off geopolitical noise, capturing real nuclear contract momentum, and defensively positioning in tech without panicking. With Nvidia's earnings looming to test this new floor, the ultimate question is, will retail investors who took profits today be forced to buy back in at higher prices tomorrow? We'll have to wait and see. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe. See you next time!